Welcome back to the deep dive. We always try to bring you topics that help you really get a grip on things that, well, matter. Today, we're diving deep into off-plan real estate investing, especially for those just starting out. It can seem a bit daunting at first, but we've done some digging, gone through a lot of expert analysis, and we're ready to break it down.
Exactly. We're really zeroing in on some practical strategies that you can use to navigate this world of off-plan investing. It's got its own unique set of opportunities and, of course, challenges.
Right, and the first thing that jumps out from all this research is understanding market cycles. We all know the economy has its ups and downs, but when we're talking about buying or
It's especially sensitive to those broader economic shifts. When the economy is doing well, everyone's optimistic. People are much more likely to commit to, future purchases like off-plan. But when things get a bit uncertain, like with inflation, interest rate changes, government policies, people become more cautious.
that makes sense. You're not actually holding a physical asset in your hand just yet, right? It's more like a promise of something to come in the future. So if the future feels shaky, that promise might not seem so secure.
Precisely. And that hesitancy can lead developers to react. During those times of economic uncertainty, some might actually lower their initial prices to attract those early buyers and keep things moving. But on the other hand, when the economy is booming and demand's high, you could see those off-plan prices shoot up pretty quickly.
So it's not just a matter of the market being up or down right now, but also trying to figure out where it might be headed while the property's being built. There was something about a Swiss economist offering advice on predicting these market shifts. While we might not all be expert economists, what are some more practical things we can look out for? That's a great question. While those high-level economic forecasts can be complex, there are some fundamental things to watch. You can look at building permits. Are they going up or down? What about consumer confidence surveys? Are people generally feeling good about the future? If you start seeing a consistent downturn in these areas, it could be a sign that the property market might be cooling off. Keeping an eye on what central banks are saying about interest rates is also crucial. Higher rates can mean higher borrowing costs, and that can affect demand for property. And for more specific insights into the property market itself, resources like Alan's blog can be really helpful. They offer expert analysis and keep you updated on current trends. It's all about arming yourself with the right information.
All right, some solid things to keep an eye on. So moving on to the next big strategy, assessing the developer's reputation and track record. I mean, it sounds obvious, but when you're looking at these flashy brochures for new developments, how do you really make sure you're dealing with a reliable developer? It's absolutely crucial. You're basically entering into a big agreement with this developer to deliver on their promises. Their past performance is the best way to judge what they'll do in the future. Our research really emphasized looking at a few key areas. Have they consistently delivered their projects on time? Have they stayed within budget, avoiding those big cost overruns that could affect the final product or even derail the whole project? And maybe most importantly, what have past buyers said about their experience? Were they happy with the quality, the communication, the whole process?
So you've got to go beyond the pretty pictures and dig into their history a bit. Where can you typically find this kind of information? Online reviews, industry forums, Alan's platform? What should we be looking for specifically?
Exactly. You want to see if there are any patterns. Do you see consistent complaints about delays or shoddy construction across multiple projects? Are there reports of the developer not addressing problems after the project is finished? Or, on the flip side, do you see a lot of positive feedback, comments about professionalism, transparency, and a commitment to quality? Industry forums can sometimes give you more detailed discussions and insights from people who are actually working in real estate. And platforms like Acelands can bring all that relevant information together, maybe even give you a more organized view of the developer's track record in past projects. The bottom line is, choosing a developer who has a proven history of completing projects successfully on time and within budget is a major way to reduce risk.
Makes total sense. All right, let's talk about early bird discounts. This sounds like a pretty good deal for someone just getting into the market. How do they work, and what are the potential pitfalls?
This is one area where it can be particularly advantageous, especially for first-time investors. Off-plan properties are often priced lower during that initial launch phase. It's not just a nice gesture, it's a strategic move by developers to generate early sales and create buzz around their project.
So they get some early wins and some upfront funding, and the buyer gets a better price. Win-win, right?
Exactly. For someone new to the market, This is a real opportunity to get a property at a more affordable price than what it might cost later on as construction progresses or once it's finished. Remember that advice from the Swiss economist about locking in prices early? Well, this is a perfect example. As the project moves forward, more units get sold, and the completion date gets closer, those initial discounts usually shrink or disappear altogether.
So buying early at a discount could mean bigger profits later, right? Especially if the property's value goes up once it's completed.
Exactly. That difference between your initial discounted price and the eventual market value can translate into a significant capital gain. But it's really important to remember that this potential upside still depends on those fundamentals we talked about. Understanding the market, and most importantly, picking a reputable developer who'll deliver on their promises. A discount doesn't mean you can ignore the risks altogether.
Right, it all connects back to those basics. Now let's talk about location, always a big factor in real estate. But with off-plan, you've also got to consider future infrastructure developments. How do you assess the future potential of a location when what you're buying doesn't even exist yet?
You're not just buying into what the location is today, you're investing in its future. The research we've looked at emphasizes the need to look beyond the amenities that are there right now and really investigate what's in the pipeline. Think about new transportation links. Are there plans for new train lines, bus routes, highway expansions? What about commercial developments, new shopping malls, business parks, leisure facilities that could make the area more appealing? And don't forget about those broader urban expansion plans. Is the city or region actively investing in developing that particular area?
So you've got to put on your urban planning hat and try to see the long-term vision for the area. A place that might not seem so great today could become really desirable in a few years because of those planned improvements.
Exactly. And that future desirability is what drives property values up. Think about areas that are targeted for big investments, whether from the government or private companies. Off-plan properties bought early in those locations could see their value increase significantly as those developments become reality and the area becomes more connected and attractive. Our sources specifically mentioned the Allen Times as a great way to stay informed about local development news and trends. Keeping track of these future plans is absolutely essential for making smart, off-plan investment decisions. It's like having a sneak peek into how the area's value might change.
Almost like having insider information on growth. All right, let's get into some of the practical details. Payment plans and exit strategies for someone new to investing, those staged payments that come with off-plan often seem like a big advantage.
They can be, for sure. Off-plan purchases often give you more flexibility with payments compared to buying an existing property. Instead of needing one huge lump sum up front, you usually make payments in stages as the building is being constructed. This can make it a lot easier for first-time buyers to manage financially, spreading the cost over time. But the analysis we've looked at stresses the importance of really understanding the details of that payment plan. When are those payments due? What parts of the construction trigger each payment? What happens if you miss a payment?
Yeah, you definitely need to go through those details carefully. And even before the property exists, you need to be thinking about your long-term plan, right? What's your exit strategy? Are you going to rent it out for income, or are you looking to sell it for a profit once it's finished?
Exactly. Ideally, you should have a good idea of your potential exit strategy even before you sign on the dotted line. Our sources recommend considering things like market liquidity. How easy will it be to find tenants or buyers for your property in that location once it's ready? What's the demand like for similar properties in the area, both now and in the future? Understanding these factors can help you make a better decision about your initial investment and make sure you have a realistic plan to achieve your goals.
Working backwards from your end goal, that makes a lot of sense. Now, obviously, buying something that's still in the planning stages comes with some level of risk. How can someone new to all this mitigate those risks using legal protection?
This is a crucial aspect of off-plan investing. There are inherent risks like potential delays, changes to the original designs, or in the worst case, the project not being finished at all. That's where strong legal safeguards come in. Things like performance bonds, which offer financial protection if the developer doesn't meet their obligations, or insurance policies that cover specific risks, are really important.
So these are basically safety nets to protect your investment if things go wrong during development.
Exactly. And our sources strongly recommend getting advice from experienced real estate lawyers. They can help you understand the purchase agreement, spot any potential red flags, and make sure those important protective measures are in place. Investing in good legal advice upfront is one of the smartest things a first-time off-plan investor can do to safeguard their investment and avoid potential headaches or losses later on.
Can't argue with that. Lastly, the research we've gone through talks about this really interesting and evolving area, tokenization in real estate. For someone who's new to investing, that might sound a bit complex. Can you break down what it is and why it might be relevant for a first-time buyer?
Sure. So, tokenization in real estate basically means creating digital tokens on a blockchain. Think of it as a secure, shared digital ledger that represent fractional ownership of a property. It's kind of like dividing a big asset, like a building, into many smaller digital pieces.
So instead of having to buy a whole apartment, someone could potentially buy a small piece of it.
Exactly. And this makes it a lot easier for people to get started with real estate investing, especially if they don't have a lot of capital. You don't need that huge upfront investment anymore. Tokenization allows you to invest smaller amounts, which opens up real estate to a much wider range of people.
That could really change the game in terms of making property investment more affordable. The research also mentioned increased liquidity and transparency. How do those fit in?
Because these digital tokens can be traded on special online exchanges, there's the potential for them to be more easily bought and sold compared to traditional real estate, which can be harder to sell quickly. If you need to get your money out, selling a tokenized fraction could be much faster and easier than selling an entire property. And, because it's all based on blockchain technology, there's a transparent and permanent record of ownership, which makes transactions more secure and easier to track. Our sources pointed to platforms like Gold, which are actively using blockchain and cryptocurrency to make these kinds of fractional real estate exchanges happen, especially on a global scale. It's a really exciting development that could change how people invest in property.
Sounds like it could democratize real estate investing in a big way. So, to sum it all up for our listeners who are thinking about getting into off-plan real estate, understand those market cycles, do your homework on the developer's track record, look for those early bird discounts, think strategically about location and future developments, carefully evaluate payment plans and your exit strategy, make sure you've got legal protection, and keep an eye on new trends like tokenization. That's a lot to take in, but it's all really valuable stuff.
It is, and it's about being both optimistic and cautious when you're approaching the off-plan market. Using those resources we mentioned, like Alan's blog and platform, and staying up to date on innovations like those happening with Gold, first-time investors can navigate this market with more confidence and potentially see some great returns.
This deep dive has been really eye-opening, and it leaves me with a question for you, our listener. With fractional ownership becoming more accessible through technologies like tokenization, how do you think this will change the world of real estate investing in the years to come? It's something to think about. Thanks for joining us on the deep dive.